So step 5, we talked about categorizing transactions. This is a big one. So categorizing your transaction starts with your chart of accounts. And I say this is a big one because this is typically where I spend a lot of time when I am working with entrepreneurs on making sure that their chart of accounts is thorough, and that is accurate and it reflects their business. So it allows you to see the following in terms of your assets, your liabilities, income, and I say income, revenue, sales, depends on what you call it, but it's all one and the same, and your expenses. So some of the sample chart of account items that you would have under assets is your cash, your current assets. Current assets are things like accounts receivables, your inventory. Just a quick refresher from financial statements session, your current assets, anything that's going, anything that's going to be used or anything that's going to move within 1 year, right? So anything under a year. Your fixed assets, anything over than that, right? So equipment, your office furniture, that sort of thing, and other assets, any prepaid expenses, so on and so forth. So your liabilities, you have your accounts payable, things that you owe other people. Current liabilities, same thing, anything that's coming due within a year. So that's your account, accounts payable, the sales tax, credit cards, right? Long-term liability are things like your mortgage, your loans, and then of course you have other miscellaneous liabilities. Then when we move, because that's kind of your balance sheet chart of accounts, then we talk through your income statement chart of accounts, and that's your, I put here as samples, online sales versus B2C sales or B2B sales, or wholesale, right? And then you have expenses, cost of goods sold. Those are things like your raw materials, your packaging, labor, rent. General expenses are things like your salaries, insurance, legal fees, licenses. And then you have, any other expenses, which are expenses outside of your normal day-to-day business operations. So like one-time fees, things that you don't typically incur as it relates to being able to do business. So I wanted to kind of go through, well, this is just an example of it was a uniform system of accounts for restaurants. And so this account number thing kind of only matters when if you're doing your accounting manually. It's helpful to be able to kind of assign your chart of accounts numbers. Most online software and tools will do that for you, so you don't have to do that, but you do have to make sure that you are adding in, especially in QuickBooks, that you've added in the right accounts, and they even maybe renamed them accordingly. So again, this is more so on the balance sheet, but when we think about the income statement, that's where I feel that I find a lot of people haven't thought through their chart of accounts as much. So I want to kind of go back to the income statement. So in terms of income and revenue, making sure that you're really clear. So for example, if you're selling a product, right? And now if you're selling a product, you have a bakery and that's the only way that you sell, then that's fine. You can have one income stream. But if you have your bakery, like your brick and mortar sales, but you also have your online sales, you'd want to see the difference between those two, right? And then maybe if you're doing different markets or different events and you're doing catering, or let's say you have bakery, but you are also doing catering, you would want a separate chart of account that has a line item that says catering income versus online sales versus your brick and mortar income. And the reason why you would want to separate those out is because you really want to be able to understand and take a step back. And what I've done with some entrepreneurs is they've been able to take a step back and realize, oh, wait, I thought my online sales or I thought my, brick and mortar sales were really profitable, but now I'm actually realizing that they aren't. And so same thing when it comes to expenses, you'd want cost of goods sold separated out by your income streams. So you would want cost of goods sold online sales, cost of goods sold catering sales. So you can really see the profitability, not just for your company overall, but also the profitability for the different types of income streams that you might have. And so that's very important, again, so you can make certain business decisions, figure out where you need to pivot, figure out maybe maybe there's places you need to do additional marketing. Maybe you realize your profit margin is really high on one particular thing, and so you need to spend more of your energy doing that. Or maybe you realize the thing that takes more of your time is actually the least profitable. So maybe spend more energy and more resources in the income stream that allows you to be most profitable. Any questions on that before I move on? Okay. So I wanted to touch on inventory management, just briefly and enough, just to kind of, it's going to be very high level, but I definitely wanted to make sure that we got to it, because I know that some of you guys will have inventory or do have inventory. So obviously inventory management is a process of ordering, storing, and using your company's inventory. So you have your raw materials, right? So I tried to make it for some things that you guys will have, which are your ingredients, right? Your flour, your sugar, whatever it is. For those who have restaurants, I'm sure it's much more complex than that. Those who are doing baking probably understand. Then you have your work in progress. So any raw materials in the process of being transformed into finished products. You have your finished products, your packaged items. And of course, you also have some of the packaged materials. So obviously you have some, for those of you who are making packaged goods, you have labels, whether it's nutrition or logo, right? Like you have to get those printed, you have to buy the labels themselves. Then you have the product packaging, right? Any jars or plastic containers, whatever it is that you are packaging your items in, you have the cost for those. And you want to be able to understand that. And kind of going back to my point about chart of accounts with the income streams, same thing. So like, let's say, for example, you are um, baking cupcakes or cookies or whatever. And even then it may be helpful to separate the types of cookies or bread or whatever it is that you're baking, so you can also still see what's most profitable, like which clients are buying which, right? Which products are doing well. So not to make it overly complicated, but it is helpful probably for you to even want to be able to see that. Also, packaging, which products cost me the most, because I have this very fancy, expensive packaging that I'm not even able to maybe buy in bulk. So it costs me a lot more to have it, and then maybe costs me money to store it as well. Um, Keep in mind, as we mentioned before, inventory is a balance sheet item, right? So it represents a current asset and is accounted for using one of the three methods. So you have FIFO, LIFO, or your weighted average costing. And again, this is a crash course on these things. But FIFO is what it stands for, first in, first out. So that's most commonly used, right? So the first, the first inventory so the first, let's say, bag of flour that you purchase, that's the first one that is going to go out. And that's the first one that you're going to cost for in terms of going out, which makes sense. The idea is that you're using the oldest stuff first, right? It prevents obsolescence, and it's assuming that the cost of the inventory purchased first will be recognized first. Then you have LIFO, which is last in, first out. So this is a helpful tool when prices are rising. And so to not get too complicated, one of the differences between FIFO and LIFO is basically what is the sort of economic environment. And so LIFO is definitely very helpful when in an inflationary environment, which is basically when prices are rising, because the last in, first out, you're accounting for likely the most expensive thing first, and then getting to the quote unquote potentially cheaper goods, because those are the things that you purchase when prices were lower. And then you have weighted average costing, which is literally just taking an average cost of your inventory. So basically, if you bought these items at $10, a month later you bought the same items at 20, you'd add them together, $30 divided by 2, and you just account for $15 per item across the board. Like I said, FIFO is typically the one that's mostly used. And when it comes to inventory management methods, you have your just-in-time or materials requirement planning. Just in time is typically the way that people use. And I think for the food and beverage industry, just in time is pretty much what is used, which is basically you're only keeping, the minimum amount of inventory that you need to produce or sell your products. So basically you don't want to keep too much inventory and have, especially in the food and beverage industry, and have that inventory go bad, because pretty much everything has a shelf life, even if it is a long shelf life. So you don't want to buy too much in bulk and too far in advance of what that your sales might actually be. Now, some of the potential issues with just in time is that, hey, what if sales spike up and you may not have enough inventory to account for that? So you may have some delays in fulfilling some sales orders because, you've only been keeping what you need on hand at the time. Materials requirement planning is based on more forecasted sales. Again, that's something that's a little bit more complex. Larger companies, more like manufacturers, is where that makes the most sense, but I still wanted to at least cover and explain the two. Want to pause and make sure there are no questions on FIFO versus LIFO when it comes to inventory management. And also just making sure when we're talking about chart of accounts that you have for inventory, or cost of goods sold, right? Because you want to see what your total cost of goods sold, because you want to make sure you're profitable. So you definitely want to keep your cost of goods sold at minimum at 50% or less of your sales, right? And that's at least that's a basis point of where you want to start, because keep in mind your cost of goods sold is just the cost of doing the business, like your ingredients, your raw materials, your inventory, all of that. That doesn't include, salaries. It doesn't include administrative and general office expenses, any overhead expense. I mean, it includes some of the rental that should be included in your cost of goods sold, but a lot of the other administrative expenses won't be included in that, but they will come after that gross profit line. So you want to make sure that that gross profit margin is strong before you start accounting for all of the other administrative expenses that will come, so that you can still have a net income at the end of the day.